Corporate Finance Practice Problem. In this presentation, we're going to work a practice problem in Excel related to leverage ratios and projected expansion scenario. In other words, we're going to think about the leverage ratios before and after and expected expansion, those leverage ratios being the degree of operating leverage, degree of financial leverage, and the combined leverage. Get ready. It's time to take your chance with corporate finance. Here we are in Excel. We have the information on the left-hand side. We're going to put that into the blue area into our worksheet on the right-hand side. We're considering a situation where we want to have an expansion that will cost $2,500,000. Two ways that we can finance that expansion. We have two options for it. One, we can finance it through debt with the issuance of bonds. That would require 9% interest payments on the bonds. Or we can have the stock issuance and we can issue stock for it for the 50,000 shares at the $50, and that would be equaling the $2,500,000. Obviously, if we'd financed it with debt and bonds, we would issue a $2,500,000 bond at the 9%. Those are our options. Now, there's pros and cons, of course, when you're considering these types of options. Obviously, when you take out debt, you got to be paying the interest and you have added risk on it. When you issue the stocks, then of course you're providing purchasing power, or you're providing ownership or voting power into the company as well, giving away some of the equity within the business. So pros and cons of either scenario. We have our information down below where we have the income statement. Our income statement, we have our earnings after taxes, bottom line of the income statement, net income. We have the shares currently outstanding, 120,000. That gives us our earnings per share. If we were to divide that out, the net income divided by the number of shares, currently at the 4.85. The expected increase in sales after the expansion. Why are we expanding? To get more assets. The assets should help us to generate larger revenue. So we're expecting then the revenue to be able to increase by $1,500,000 if we were to do the expansion. The variable cost percent of sales is going to be 30%. The fixed cost will increase up to $1,350,000. The tax rate is going to be 35%. We're going to compute our ratios, the degree of operating leverage, degree of financing leverage, and combined leverage, both before we do the adjustment and then afterwards. So we'll do these calculations first. Then we'll create an income statement based on the two scenarios. Then we'll do these calculations once again afterwards. We will do this a bit faster because we have seen these ratios in the past. We're just kind of applying them out in practice now with a practice problem in terms of a scenario situation. So let's calculate the degree of operating leverage where we start off at. We're going to be calculating the contribution margin. That's going to be the numerator. There's a couple different ways we can do it. I'm going to do it this way by picking up the sales here. We're going to take up the sales, and then we're going to be comparing that to the variable costs, and that's going to give us our contribution margin. So then the sales are going to be equal to the $3 million, the variable costs equal to the $900,000, contribution margin subtracting those two will be equal to the $3 million minus the $900,000, or the $2,100,000. Let's go ahead and indent these. We're going to select these three items. Home tab, alignment, increase the indenting, then go to the contribution margin. Home tab, alignment, increase the indenting once again. The denominator then has the operating income, or could be called the contribution margin, minus the fixed costs. Let's calculate it that way. And that's what we see in our denominator here. So we've got our numerator now in the outer column. We want to get our denominator then in that outer column in our little kind of worksheet type format for this calculation. So the contribution margin, let's start off with the contribution margin and then subtract out the fixed cost to get to the operating income. So the contribution margin here, I indented that. Home tab, alignment, increase the indenting. This is going to be equal to, hold on a sec, undo that. This is going to be equal to the $2,100,000. Then we're going to be picking up the fixed costs here. Let's indent that to home tab, the alignment, increase the indenting. That's going to be equal to the $804,000. If we subtract those two out, we're going to get the contribution margin minus the fixed costs. I'm going to remove the colon at the end of this thing. Remove the colon. Let's go ahead and indent it 2 times now. Home tab, alignment, indent, and indent again. We'll then take this to the outer column. This is going to be our denominator, which is going to be the 2,100,000 minus the 804. That's going to give us our 1,296,000, which is, of course, this number as well, operating income or earnings before interest and taxes, or contribution margin minus the fixed costs. Let's put some underlines here. So we're going to go Home tab, Font Group, underline here. Let's put an underline there, Home tab, Font Group, underline there. That's going to give us our degree of operating leverage before we do anything else, and that's going to be equal to the 2,000,001 divided by the 1,902,296. Let's then add some decimals. We're going to go Home tab, Font Group, add a few decimals. We could keep on going, and we're going to stop at 2, however, like we normally do. Then we're going to go to the degree of financial leverage, which is going to be the earnings before interest and taxes divided by the earnings before taxes. So these are straight on our income statement. So I'm just going to say this is going to be equal to earnings before interest and taxes, and otherwise known as operating income could be called, right? Operating income, so earnings before interest and taxes. And then we're going to say the earnings after or before taxes, which means after interest, but before taxes. This will be equal to earnings before taxes, the difference between these two being the interest, and that's going to give us our degree of financial leverage, and that's going to be equal to the 1,296,000 over divided by the 896. And I had some subtractions in there for some reason. This number divided by that number. That's going to give us 1. Let's go to the Home tab. Numbers, increase some decimals. Could keep going. We're going to stop at 2 to get us to that 1.45. Next, we're going to have the degree of combined leverage. Degree of combined leverage, which we could calculate one way. We could be multiplying these two out, meaning this could be equal to the degree of operating leverage times the degree of financial leverage. Let's add some decimals. Home tab, the numbers group, add a few decimals. We could keep on going. We're going to stop at 2. That will give us the 2.34. We can also calculate it by taking the contribution margin, as we could see in our little equation up top. Contribution margin divided by earnings before taxes. The contribution margin we already calculated. That's over here in our degree of operating leverage, the 2,000,001. And then we've got the earnings before taxes. Let's pick that up on the income statement. Earnings before taxes is going to be this item here, earnings before taxes. And that's going to be equal to then the amount that's kind of next to that, the name, because that's number next to the name of the 896,000. If we divide this out, we're going to take the 2,000,001 divided by the 896. That's going to give us 2. Let's go ahead and add the decimals. Home tab, numbers, add a few decimals. Let's put the name here. This is going to be the, or I can just put an equal sign. Let's say this equals that name, same name. Okay, so there we have it. So that we've done our calculations before. Now let's think about creating the income statement based on the adjustments, the assumptions that we're going to make for our expansion. So to do that, let's hide some cells. I'm going to be hiding. I'm going to put my cursor on cell D. I'm going to be selecting on over until I get to M. So D to M, dem. And then we're going to right click on that area and we're going to hide it. So we're going to hide those cells. All right. And then we're going to be calculating our income statement. We're going to do it in basically a contribution margin type of format. So we'll be calculating the contribution margin. Now we have the totals here, total sales and variable costs. So we're just going to say totals instead of breaking it out to like per units. So I'm just going to be picking up the sales then. And we saw that the sales are going to be increased or expected to increase by 1,500,000 if we do the expansion of the cost of 2,500,000. So we're going to say, okay, that's going to be the same for the bonds. If we finance it with bonds or stocks, we expect in either case sales to be increasing by that 1,500,000. So we're then going to say, all right, this is going to be equal to then the 3 million where it started, and then plus the 1,500,000 down here, plus the 1,500,000. We could do the same here. I'm going to take the, well, I could just, it's going to be the same. Let's just take equals that number. And there we have that. And then we're going to say the variable costs are well, let's just do it this way. This equals the variable costs. Now the variable costs are going to be 30% related to sales because they're going to be increasing in relation to sales. That relationship is 30%. So we're then going to be saying this will be equal to then the sales times the 30%. Now I want to copy this over, and I want to keep that as an as not from moving. So I'm going to make this an absolute reference by saying F4 $ before the B and the 27. Then I'm going to take this cell and autofill it across. So put in my cursor on the fill handle here and autofill it across, double clicking on it to double check that it does what we expect. It does. So then we're going to go to the fixed costs. Fixed costs are going to be equal to, they said the fixed costs are going to be increased to the 1,350,000 if we do this expansion. So we're going to say, all right, that's going to be fixed. It is what it is. The 1,350,000, that's going to be the same under whether we finance it, either way that we finance. Let's put the underline here, go into the Home tab, Font Group. Let's put the underline there. That's going to give us the earnings before interest and taxes. Earnings before interest and taxes. That's going to be the sales minus the variable cost minus the fixed cost. So this is going to be equal to the sales minus the variable cost minus the fixed costs. Now you could also do that with a sum formula. Let's check that out. That'll be nice. You could take the sales minus the sum of brackets, these two numbers, closing up the brackets, embedding the sum function. So there we have that same way to get to the same spot, or different ways to get to the same spot. Then we're going to have the interest. So then we'll have the interest. This is where things will start to vary and different between the financing options, of course. So we're going to say interest up top, if we take on the bonds, means we're going to have to issue $2,500,000 bonds at interest rate 9% annually. That's going to give us the interest of the 225,000 interest. And then we already had apparently interest down here of the 400,000. So we'll have to increase it by that 225. So I'm going to double click on this again. So I'm going to just add and say plus the 400,000. So we got the 400,000 that we started with plus the interest on the new financing of the 2,500,000 times the 9% gives us the increase of the 625,000. So then we're going to have the interest on the second option, stocks. If we issue stocks, we don't have any added interest. We only have the interest that we're going to be continuing from the prior financing that we had, and that's going to be the 500 or the 400,000. Let's put the underline here. We're going to go to the Home tab, the numbers group. Let's put the underline there. Then we're going to have the earnings before taxes, after interest before taxes. Subtracting this out, this is going to be the 1,000,008 minus the 626. We'll do the same thing here. We can copy this over. Control C, Control V. So there we have that. And then we're going to be calculating the taxes. Taxes were at the rate of 35%. We can see down here. Now the taxes will differ, of course, now too, even though the earnings before interest and taxes were the same due to the fact of the financing making the interest deductible. If we have the bond side, so we have more interest that's deductible, making the taxable income lower. So we're going to have less tax here because we're going to have the same tax rate. I'm going to take this number times the rate down here, which is the 0.35. I want to make that not move if I copy and paste the cell or when I do so. Therefore, I'm going to say F4 on there. That's going to give a $sign before the B and the 29. Then I'm going to copy that, Control C, paste it on to the other side, double click on it, see if it does what we expect it to do. It does. That's good. Then we're going to get the earnings after taxes, bottom line number on the income statement being calculated as earnings before taxes minus taxes. And then I'm going to copy that cell, Control C, paste it on over, Control V, put an underline here for formatting purposes, Home tab, Font Group, underline, and there we have our bottom line number, which differs, of course, even though the sales went up in the same place due to the financing and its effects on the interest and the taxes. Okay, and then we also going to have impact with regards to the shares that are going to be outstanding, the earnings per share. So if we then think about the earnings per share, we can say, well, the earnings per share then are going to be, if we issue bonds, the same. The 120,000 shares outstanding. We didn't issue any more shares. If we finance this thing with stock that we're going to issue, Well, now we've got the 120,000 shares plus the added 50,000 shares that we had to issue at the $50 sales price. So now if we issue stock, then of course we have more stocks that are out there, and we've kind of, we had to give more voting power, power in the company, ownership power in the company for the stock option, but we didn't have to pay interest that way. And on the bonds option, we financed it. We have to pay interest, but we didn't have to issue more stocks. So then we're going to say that the earnings per share then is going to be equal to the earnings after taxes divided by the common shares. Let's add some decimals. Home tab, numbers, add a few decimals. Let's do that over here. We could add more, by the way, but we're going to stop at the 2. And then we're going to say, let's do the same thing here. The earnings after taxes divided by the shares, adding some decimals. Home tab, numbers, adding a couple decimals here. Whoop. And we'll stop at 2. So there we have that. So once again, another change is going to happen here due to the different ways that we think about financing, either through debt or through the bonds. So now let's go through our degree of operating leverage again. We'll do our leverage ratios now that with our new income statement for both scenarios, bonds and stocks. So if we go back to the degree of operating leverage, that's going to be the contribution margin divided by basically operating income. So we'll do our calculation here. Once again, we're going to have the contribution margin, which is going to be equal to, let's say, the sales minus the variable costs is going to give us our contribution margin. I'm going to get rid of the colon here. And the sales for the bond scenario is the sales number minus the variable cost. And the contribution margin, I'm going to put that in the outer column, is going to be equal to the sales minus the variable costs. And it's going to be the same for the stock. So we could do the stock at the same time. I'm just going to, this header up here is for the stock, same process. This is going to be equal to the 4,000,005. This is going to be equal to the variable cost, 1,350,000. The difference between the two, 4,000,005 minus 1,350,000, 3,150,000. Then we've got the fixed costs, the contribution margin minus the fixed cost, or the operating income. And that is going to be equal to, we can take the same contribution margin number as our starting point. Same starting point here. And then we're going to subtract out the fixed costs, moving out the fixed costs. Fixed costs are going to be the same for both. Once again, fixed costs are the same, so that's going to give us our contribution margin minus the fixed costs. This will be equal to the contribution margin minus the fixed costs. This will be equal to the contribution margin minus the fixed cost. Now we've got the numerator and denominator in our outer columns here, and we can then of course calculate the degree of operating leverage, and that's going to be equal to the numerator divided by the denominator. Do it over here too. This equals the numerator divided by the denominator. Let's go ahead and add some decimals, selecting these items down below, go into the home tab, go into the numbers group, adding a few decimals. Let's add some underlines. I'm going to do this by holding down Control to put the underlines in at one time. So I put my cursor here, then hold down Control and select the ones I want to underline so that I can underline the non-adjacent cells or select them at the same time, and then let go of Control, Home tab, Font group, and underline. So there is our underline there. So we're at the 1.75 either scenario. Then we're going to go to the degree of financial leverage, which is the earnings before interest and taxes divided by the earnings before taxes. So I'm going to say this will be equal to, scrolling on over, we got to do a bit of scrolling here, so hopefully that doesn't bother too much. We got earnings before interest and taxes divided by earnings before taxes, the difference between the two being the interest. Picking up the new numbers we have for the bonds and the stocks. So for the bond scenario, earnings before interest and taxes, 1,008,000. For the stock scenario, earnings before interest and taxes also 1,000,008. Now the difference here, due to the interest, bonds earnings before taxes are now going to be earnings before taxes, the 763,750. I'm sorry, hold on a second. That's not right. Earnings before taxes are going to be this 1,175,000. So there we have that. And then we have the stocks earnings before taxes are going to be the 1,400,000. Then we're going to underline those, selecting them, home tab, font group, underline. That's going to give us our degree of financial leverage, which is going to be equal to the numerator over the denominator. And this equals the numerator over the denominator. Let's add some decimals, selecting these two, home tab, font group, adding a few decimals. Could keep going. We're going to stop at 2. Then we have the combined leverage. A couple ways we can calculate it. So this is going to be the degree of combined leverage. And so say this, just paste it there. And one way we can calculate it is to multiply them out. So we can say, all right, for the bonds, it's going to be the degree of operating leverage times the degree of financial leverage. Same with the stocks. We're going to say it's going to be the degree of operating leverage times the degree of financial leverage. Adding some decimals here, selecting these two, home tab, font group, adding a couple decimals. So there we have that. We can also calculate it as the contribution margin over the earnings before taxes. So the contribution margin, you'll recall we calculated over here in the degree of operating leverage. So we will say, let's pick that up from that calculation for the bonds and for the stocks. And then we have the earnings before taxes. Let's pick that up from the income statement. So I'll scroll on over to the income statements, earnings before taxes. And this is going to be equal to then the earnings before taxes on the income statement of the 1,175,000. And then we're going to say this is going to be equal to the earnings before taxes on the income statement of the 1,004,000. Let's divide these two out, that being the numerator divided by the denominator. We can copy that, Control-C, paste it, add some decimals, selecting those two, home tab. We're going to go to the numbers group, adding a few decimals. Then we're going to say this is going to be equal to the same degree of combined leverage. So there we have it. So you can see if we compare these two options now with regards to leverage, when we did one with financing with bonds and then stocks, we have no difference in the degree of operating leverage because that has to do with the fixed costs versus the variable costs. And there was no change in the fixed costs, meaning if the fixed costs are higher related to the total cost structure, you have more risk, more leverage. As these leverage items go up, there'd be more risk. But there was no change to the fixed costs or variable costs. It was really due to the financing side of things. So then if we think about the degree of financial leverage, we do of course have a change. And then that's going to be with relation to the bonds. We have a higher degree of financial leverage as opposed to the stocks. That's because when we financed it with the bonds, we took out more debt, right? So we took out more debt. And that means we had more leverage with relation to the debt. Whereas the stock, there's pros and cons to either way. The stock, we had to give up some of the equity in the company, have more more voting power stock to finance it. But we don't have the leverage that comes along with that type of financing of the expansion. So the bonds then increases the leverage. Obviously, the leverage, when it increases both the risk that could be increased, and leverage could have an effect of a multiplier effect on the in good times. So we've talked about that in the past. So there's going to be more leverage with the bonds, and then of course if you combine them out, then the bonds, the combined leverage, the bonds are going to have more leverage than the stocks as you combine them together.